Midnight in Washington, the board flashes green, 308 to 122, as the vote explodes across the chamber. Stablecoins are now U.S. law. Within hours, billions shift into digital wallets, banks warn of a run, and retail giants scramble to mint their own money. At the center, Donald Trump, signing the bill that could rip billions from Wall Street while his own crypto empire swells past $2 billion in profit. This isn't regulation. It's a rewiring of the American dollar in real time. Just 3 years ago, that would have been unthinkable. In the wake of the FTX collapse, stablecoins were the suspicious cousin of an industry Congress barely understood. Now, under the Genius Act, they have a government-issued rulebook and a president with personal stakes measured in hundreds of millions. The final House vote, 308 to 122, looked bipartisan. But the Senate's earlier 68 to 30 approval was the real shockwave. Lawmakers who had built careers on skepticism toward digital currency flipped almost in unison. For some, it was a nod to innovation. For others, it was a nod to the man in the Oval Office. Donald Trump's ties to crypto aren't whispered. They're documented. World Liberty Financial, a platform linked to the Trump Organization, runs its own branded token and now its own stablecoin. According to Bloomberg, ventures like this have added over $620 million to Trump's net worth in the past year alone. In total, crypto now makes up a significant slice of his estimated $6.4 billion fortune. The Genius Act's requirements are straightforward in text, but honestly, sweeping in consequence. One-to-one reserves for every digital dollar issued, assets held in cash or short-term treasuries, and monthly public audits. That means issuers can no longer rely on the shadowy reserves that once plagued the sector. For stablecoins, legitimacy just got codified into law. But here's where the air turns heavier. The very framework designed to protect the public now sits in the hands of someone who directly profits from the market's growth. Ethical concern isn't theoretical, it's structural. When the rulemaker is also a beneficiary, confidence and suspicion grow in equal measure. On signing day, Trump wasted no time touting the bill as a victory for American innovation. Within hours, shares of crypto-linked companies surged. Ethereum's price spiked to a year high. Bank analysts who had dismissed stablecoins as a fad were suddenly on earnings calls, acknowledging their threat to traditional payment systems. If consumers can send dollars instantly, for pennies, without a bank's involvement, why keep a balance at all? Banks know what's at stake. JP Morgan's Jamie Dimon, Bank of America's Brian Moynihan, Citigroup's Jane Fraser, all have warned about the destabilizing effect of funds moving out of deposits and into digital wallets. And now, those wallets have federal legitimacy. That shift isn't just theoretical. Walmart, Amazon, and major U.S. banks are already mapping out their own stablecoins. These are the same corporations that a few years back called crypto untrustworthy. Now they're rebranding it as a seamless payments tool. The about face is so stark, it almost reads as parody, until you realize the race is already underway. While the Genius Act is phase 1, another bill is waiting in the wings. The Clarity Act. This would define the entire crypto market structure, splitting regulatory oversight between the SEC and the Commodity Futures Trading Commission. Under it, most decentralized assets would move to CFTC jurisdiction, but the SEC would still act as the gatekeeper for anything resembling an investment contract. If passed, it would be the first full federal framework for digital assets. Trump wants it signed by September, but critics are pushing back harder here than they did with the Genius Act. They point to the risk of regulatory capture, where industry players shape rules in their favor. With a president so intertwined with crypto ventures, the optics are difficult to separate from the policy. Yet inside the industry, the mood is euphoric. Stablecoins are moving from speculative side bets to the rails of everyday finance debit cards, payroll deposits, cross-border transfers, point-of-sale purchases. The transformation is rapid. In this narrative, the Genius Act isn't just a bill. It's an on-ramp to an entirely new financial system. But let's step back. Because in the scramble to celebrate, something larger is happening. The architecture of U.S. money itself is being redrawn. Not by central bankers, not by an independent commission, by a coalition of lawmakers and private executives whose fortunes are tied to the outcome. Consider this. Stablecoins under the Genius Act can be issued by private corporations, backed by government-approved assets, and circulated globally. They'll look and feel like dollars, but the issuers, not the Fed, will control the mechanics. In practice, this could decentralize certain functions of the dollar while centralizing profits into the hands of a few major issuers. There's another angle. World Liberty Financial, flush from a $2 billion investment commitment from Abu Dhabi, is not just a market participant. It's now positioned as a flagship example of how to operate under the new rules. Half of that investment is in its own WLFI tokens. The other half goes to settling debts and funding expansion. It's a self-financing loop, enabled by the very law the president just signed. So, banks are adapting, but this adaptation, well, it comes with risk. Issuing their own stablecoins could cut fees and streamline payments, but it could also, cannibalize their core deposits. Once those dollars move into a token ecosystem, they may never return to traditional accounts. That's a slow bleed to their balance sheets, and honestly, they know it. In parallel, the administration has rolled back certain enforcement priorities. Crypto firms previously targeted by the SEC are now finding friendlier ground in Washington. Executives are meeting at the White House. Bank participation is being encouraged, not just tolerated. The pivot from confrontation to collaboration has been rapid and, frankly, profitable. Ethics watchdogs are tracking all of this closely. The Center for Responsibility in Politics called the overlap between Trump's public role and private benefit a case study in conflicted governance. The concern isn't just corruption, it's systemic fragility. If the public perceives that laws are written to enrich their authors, trust in both the market and the state erodes. Still, supporters argue that the old system was broken. Without clear rules, stablecoins operated in legal gray zones, vulnerable to sudden crackdowns and market panics. Now they say the United States can lead the world in regulated digital finance, attracting investment and innovation instead of watching it flow to offshore havens. The divide is sharp. Is this reform, or is it rent-seeking wrapped in reform's clothing? The answer may depend on whether these tokens remain stable over time, or whether, like other financial innovations before them, they expand until they break. Phase 2 will test that. If the Clarity Act passes, the entire digital asset market, not just stablecoins, will have a defined place in the U.S. financial framework. Exchanges, DeFi protocols, and token issuers will know their regulator, their reporting duties, their reserve requirements. It's a blueprint for bringing crypto into the mainstream. But a blueprint is only as good as the builder's intent. And here, the builders have portfolios to protect. That's the inescapable backdrop to every press conference, every floor speech, every signing ceremony. The stakes aren't only about how money moves, they're about who controls the lanes. As the ink dried on the Genius Act, markets surged. Investors piled into coins that had been stagnant for months. The signal was clear. Washington's posture toward crypto had flipped. The risk, of course, is that the market's exuberance could outpace the law's guardrails. Because even with one-to-one reserves and monthly audits, stablecoins aren't immune to crisis. Reserves can be mismanaged. Pegs can break under stress. And in a system where political fortunes are tied to financial products, the incentive to prop up a failing issuer rather than let market discipline take its course becomes a political calculation. That's the part most headlines miss. This isn't just about regulating a product. It's about intertwining the stability of the financial system with the stability of individual political fortunes. Once that connection is made, it's hard to unmake. In the months ahead, expect the first wave of bank-issued stablecoins to hit the market. Expect retail giants to roll out loyalty-linked tokens that double as spending cash. And expect debates over privacy, security, and centralization to intensify. Because while the Genius Act sidesteps the central bank digital currency question, it doesn't erase it. A dollar is still a dollar, whether issued by the Fed or by a corporate treasury, until the public decides otherwise. The irony. In trying to avoid a government-issued CBDC, the United States may be creating something functionally similar, only in private hands, with private profit. The control shifts, but the tracking, programmability, and integration into daily life could be just as pervasive. By the time the public notices, the infrastructure will be invisible. Payments will clear instantly. Fees will be minimal. Cross-border transfers will feel like sending a text message. And, behind that ease will be a network owned by entities with both market power and political influence. When historians look back, they may not focus on the headlines about personal wealth or partisan maneuvering. They'll see a moment when the definition of money itself began to shift, not in the abstract, but in law. The Genius Act was the first brick in a new wall. What comes next will decide who controls the gates. So the question isn't whether this is good for crypto. It's whether it's good for the country. And that answer won't come from the rally in token prices or the applause in the Capitol. It will come from the durability of trust, both in the dollar and in the people entrusted to write its future. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.